Hi, good everyone. How you going? Phil Tarrant here. I'm the host of the Smart Property Investment Show. I've been asked by my friends over at Finni Mortgages, finni.com.au, to jump on, have a chat with Paul Glossop from Finni in relation to yesterday's cash rates decisions by the RBA. We all know that they've hiked rates for the first time in 11 years. So the first time many mortgage holders have seen an interest rate rise 25 basis points to 0.35. Paul, what do we know about this? This was expected. I know I spoke to you earlier in the week and was sort of had a question mark of whether or not they're going to move in May or June. The consensus was that there would be rate hikes. They've moved faster potentially than what they said they would a year ago, but the market have priced this in. Let me know, mate, what's happening?
But it's we literally spoke only yesterday about this, and the consensus was it was either wasn't going to happen this month, it was going to happen next month as a start, and we were probably both in lockstep in the sense that we personally probably expected that we were going to wait to see some wage growth data before they were going to move, but I think maybe there's been a little bit of movement behind the scenes pre-election that the RBA maybe wanted to be seen to be truly independent and move out of unison with I guess what the coalition probably would have preferred is to wait until after the election had occurred. But we're here. We've seen 0.25% increase. The banks are essentially going through their motions now, passing that on, making sure they maximise their cash flow straight away. Some pensioners will be somewhat happy because they probably haven't seen their income, that money that sits in a bank account, increase for a long period of time. So there certainly will be some winners out of this. But as we were saying yesterday, mate, and I think something that's a lot of investors and owner occupiers, for that matter, who have been looking at fixed rates in particular for the last 6 months have seen is that this wasn't unexpected. We have seen fixed rates for 2, 3, 4 year, 5 year fixed rates that hover around that give or take 4% mark for some time now. So we always look at those as relatively consistent lead indicators as to where we expect the price of variable money to go. And we're here, we're starting it, which, as we spoke about, there's going to be some winners, there's going to be some losers out of this, certainly.
Yeah, and a lot of people think that rate rises is a negative. It's all part of the natural dynamics that is economic markets. So we haven't had one for 11 years. So guess what? What we've been talking about is that rates will go up at some point in time. Well, the official cash rate has gone up, and expect to see the banks move pretty quickly subsequent to that. So your mortgages will get more expensive if you are on variable rate products. Paul, I think, and we sort of spoke about this, whether or not it was going to be a May rate rise or a June rate rise. I think the RBA and the RBA sort of turned a little bit because they were adamant saying we're not really going to do much until we actually see real wage growth. But they pretty much dumped that in terms of doing this. They've gone, look, it's going to go at any point in time. So let's intervene now to be good and healthy for the economy, for us to move. Whether that's right or wrong, that's really not for us to speculate around. But I think there was probably a sense of the RBA reinforcing its independence. It was in a bit of a tough spot. If it didn't move in May and it moved in June, some people might have called out the fact that maybe it was influenced by the coalition government as we come up to this federal election. So I think it was a clear indicator of the RBA saying we are independent. We will not be governed in our decision-making for what's right for the economy based on the politics of the day. And the RBA absolutely consistent in the continuity of what the RBA does, irrespective of who's in government. You'll see that play out over this next period of time. But Paul, a lot of people don't really get, and I know a lot of mortgage holders will be sitting there going, well, why are they doing this? The question mark made is, if things are getting more expensive and therefore our money isn't going as far as what it used to, why are they making us pay more on our mortgages? And that's that. And it sounds really counter cyclical to way it should be, going, oh, wow, if things are getting more expensive, shouldn't they make it easiest to make our repayments? Can you give me some sense to the economics of it all?
Yeah, I mean, look, really fundamentally, I think the intention of this is to slightly, ever so slightly, stifle consumption a little bit, and ultimately just give everyone a little bit of a tap of the brakes every time this happens. And ultimately, what they're trying to do is figure out, okay, well, we need people to probably just rein in the purse strings slightly, buy less, consume a little bit less, bring in the demand, because ultimately it is, as is pretty much anything in the free market and the free world, is its supply and demand discussion. And ultimately, if we buy less, we consume less ever so slightly, then the pressure on those prices to continue to increase, because essentially there will be less of that to go around. So therefore, the price only ever typically goes up. then it just means that we taper off what the price of the loaf of bread, of the litre of fuel, of the price of what we're going to be essentially paying for potentially a property will happen. And that comes down to that whole supply and demand game. So we're really trying to temper the actual level of consumption very, very, very slightly.
Yeah, and a lot of people expected. I know if you looked at the odds on it, 2 weeks ago, there's a lot more people sort of calling for or speculating for a May rate rise. And as it got closer to the date, a lot of those economists pulled back on it, including, I believe, the CBA. I didn't expect it. So it did happen. But this big question around how does a rate rise actually give some sense to economic conditions? Well, it means that the economic conditions in Australia, at least, are positive, and that's a big tick for everyone. It means that more Australians have money in their back pocket. I think a lot of that is a result of the COVID-19 pandemic and the strongest balance sheets we've ever had. But to give some sense for it all, about 1/3 of all Australians have a mortgage. So they actually got a mortgage against their home. The other third, or another third, pretty much have paid their mortgages off, so they don't have any debt at all. And the other third essentially are renters. So they're paying for rent to live in a house. So that's really broad brushstrokes. So the fact that mortgage holders are going to have to pay more in loan repayments means they've got less money, and therefore that will take some heat out of their spending. That's not a bad thing, but there's some good things, and you touched on it. The fact that if you put money in a bank, expect to get zero interest over the last period of time. As interest rates start to go up, it means people that had their money in savings and term deposits will start generating a little bit more income, retirees, for example. So they're going to start making a few more bucks as well. But one of the key factors which really influence the notion of rising rates and why you think it might be sort of counter-cyclical is that it sort of impacts on the notion of the wealth effect. So if people don't feel as wealthy because they don't think they're going to have as much money, that will inherently, just to your point, sort of tap the brakes on their spending. And if they stop spending in certain areas, what typically happens is that all prices, well, there's less demand on absolutely everything. This is really basic sort of high school economics, but this is the way it works. So it's right for central banks and the Reserve Bank of Australia in particular to use this as a mechanism to shape spending behaviour, which should therefore temper the overall sort of CPI, the cost of goods moving up. So that's the environment we're in right now, Paul. What do we do as mortgage holders? So, we're chatting largely with property investors, but also owner occupiers. If you are that 1/3 of Australians that do have a mortgage, if you're an owner occupier, you've got to be active, you've got to be proactive, you've got to make sure you got the right rate. And for those property investors, they should be thinking about opportunities in this market as we move ahead. Where do you sit with that?
Yeah, to break that down into those two categories, the owner occupiers, because I mean, the vast majority of the property investors have an owner occupied property as well. So the reality is they probably both fit into the same pool of, or the vast majority will sit in the same pool of the biggest debt most people will have in the property space will be in their own home. And that is where the biggest impact of rate rises typically come. And obviously it's typically non-tax deductible debt. So it's a very, very important discussion. The thing that we're seeing now, and I was only thinking last night, Phil, is that we're doing this over a Zoom call. The last time we saw a rate rise, Zoom didn't exist. It's that wild how long ago this was. So, I mean, this is quite fresh to a lot of people to consider when, how, why, what actually is there to do. But there hasn't really, and we talked about this briefly yesterday, is that there hasn't really been much that a consumer can do other than make sure that they're working with the correct bank with the correct policies. Now, as we're seeing this first rate rise in over a decade start to be passed through, is that we are now starting to see the real importance of having a broker and brokerage firm who really understands where, what, and how, and understands a very vast panel of different lenders and who's going to treat different lenders in a different way and what rates they're going to be able to provide. Because now that landscape, I'll tell you what, it's a red hot landscape, and it's real as far as the differences of what $1 million in debt will mean for someone who's hovering around a fixed rate unnecessarily at 4.5% versus still seeing a variable rate, which they can track at 3.1%. You're talking even that example there, well over 10 grand a year net in that scenario. And that's super common right now. So people who are being lazy with their money, not looking under the hood and not discussing with an investment broker to say, where can I get the best rate, the best structure, extract equity and still be able to propel and perpetuate my portfolio, they're the ones who are going to lose out. So for me, this is the time. If you do have a actual debt that sits in the money markets now, it is time to pick up the phone, send an email to your broker to make sure that you are assessing where your rates are going, where they're likely to be in the next 12 to 24 months if you do nothing. And then ask the question, well, what else can we do if I'm just setting myself on the sale? Well, look, if I just let my loan essentially play out the way it's going to play out, is that the best way? Because vast majority of the time, there's probably going to be a better way. The other thing which I'd probably add, and this is an important one to probably finish with from my end, is that for those property investors out there, this is, I mean, taking the money market movement aside, and this is part of the inflation position that we're seeing north of 15% increase in rental values in the last 12 months. And this is the strongest level of rental growth that we probably have seen in almost 15 years. And that's going to continue to grow. So to put that in perspective again, if you've got $1,000 a week, and I'll just give round numbers, $1,000 a week in rent, that goes up by 15%. Clearly, that's $150 a week that we're talking as far as total income is concerned. Now, that's the best part of $7,000, $8,000 a year when we're talking overall total amounts of money that are going to go into people's bank accounts. So although we're seeing the increase of cash rates go up, the rate of rental growth right now, in a lot of cases, is actually exceeding what will even be a 1% increase in rates. So don't be despaired to think that your expenses for investments is going to well and truly increase beyond what your income is. Because right now, if those assets are selected correctly, and if they're not, that's another, I guess, action point, is those investors who are listening and watching really need to get in touch with their property managers to start to discuss where their rents are at for their tenants and ask if they're actually at current market rates, because the chances are they are not.
Yeah, and the secret, as speaking of the property investor very quickly, Paul, is however and whatever happens to the markets, whether there's seismic shifts, global financial crisis, COVID-19, regulatory intervention, you want to hold on to your properties, whether it's owner occupied or as a property investor, for as long as possible. There's two key metrics to that. It's at a P&L level, is how much is the thing costing you and how much money is it generating for you. So how much is it costing you? Speak to your mortgage broker. I'm sure the team over at finni.com.au, Finni Mortgages, will be more than happy to have a yarn with you. But there's also the revenue side of things, as in what money are you generating from it? We're moving into a market. The cost of living also means the cost of rents. You should be reviewing your rents right now. So look at both sides of the balance sheet when you consider how you can amplify your ability as a mortgage broker. So Paul, is that the best way for people to contact you and your team, finni.com.au?
Yeah, mate, that's exactly right. So I think if anyone jumps on and just goes to www.finni.com.au, finni.com.au, there's an inquire now button, which basically will just allow you to reach straight out to our team. They'll typically touch base with you within the hour to set up a time to really go through the details of where your current structures are, what your intentions are in the future. And it might be a simple pulse check discussion to say, hey, what you're doing and where you're going might be absolutely correct. But for me, this is the time to get that second and possibly even a third opinion on where things are, because the chances are, I know we look at about 50 separate aggregators, 50 separate lenders on our aggregation panel. The reality is that we've got a lot of opportunities that sit out there that a lot of people might not be aware of or have access to. So without asking that question, you're simply just flying a little bit blind at the moment for people who are just working directly with a bank or potentially just happy to use one lender alone.
So in summary, interest rate hikes on the way up. Whether or not there'll be another one next month, I don't know. I reckon they hit it pretty hard to start with, so you might get a reprieve for a little bit. But irrespective of that, don't be alarmed by this. This is a natural, normal market movement. What you can do is make sure that you can prepare for it, a rising rate environment moving forward. Look at your finances, look at the way you generate your income, look at your spending, and make sure that you can weather any potential rate hikes into the future. Get used to it. Don't be alarmed. Just be aware. Paul Glossop, Finni Mortgages, thanks for your time.